what we're here to do today is to discuss reflections on our recent Building Society benchmark report, which we carried out at BehindLogin. So thank you for joining. We're going to be here for an hour. We've got some industry experts who are going to be sharing their take on what's happening in this market and their interpretations of what we've reported within this benchmark. And we're going to have some time at the end for Q&A as well. So for everyone that's dialed in, when you dialed in, you'll have seen a poll. Please go ahead and answer that question, because it'll be great to hear what your take is on that. And if you have any questions as we go, please add those into the Q&A section and we'll come back to those at the end of the session today. Okay, super stuff. So what we're going to do is we're going to start off with quick intros. I'm Gemma from BehindLogin, and what we have here today is we have 4 industry leading experts who are going to share their view on what's happening in this space. So we've got Oliver Lane, our founder and CEO at BehindLogin. Thanks, Ollie. So Ollie previously led the mobile app team at Hargreaves Lansdown, and prior to that was in product and strategy roles at mobile app consultancy Mooblu and IPG Media Brands, where we worked together previously. So how long have we been going at BehindLogin? I joined the company a few months ago, but BehindLogin's been going 4 years, is it now, Ollie?
Yeah, about 4 years, yeah.
Excellent. So we've got Ed here, Ed Golsby from Contentsquare, heads up the financial services team. Contentsquare offers an all-in-one experience platform, so it allows you to see the joined up analytics from click right through to conversion. We're working really closely with the team there on applying some of their analytics to some of our clients' technical stacks, and it's helping us to understand the journey performance at a really granular level. Thanks, Ed, for joining us. We've got Brendan Gilmore here from BPT Strategy. So Brendan's got almost 30 years experience in the game, previously a banker himself, and now helping to bridge the gap between the old world and the new world. Brendan offers consulting in all sorts of different spaces of financial services across lending, credit, strategy, fintech, offering advice and speaking and advising with companies that are trying to work out how to navigate the traditional and the new opportunities. And then we have Jonathan Stallard, who's the UK and Ireland director at Backbase. And Backbase is an AI-powered banking platform, and you support with the orchestration of open banking as well, don't you, Jonathan? So working with lots of the leading building societies, quite a few that are styled in here today, in fact. So we know he'll really understand your challenges, and especially in the AI and the agentic space. So to get us started, Ollie, you happy to give a quick intro to what we do at BehindLogin?
Yeah, sure. Thanks, Gemma. So we're a competitor market research company focused in financial services. And our model is crowdsourced research. So there's a big panel of consumers, about 1 million people now across the world, that are customers and users of all the different financial services products. We work with them. They share their screen of their apps and their websites and talk through the features and functionality. So we get this view of real customer experiences, what the market looks like. Then we benchmark them through proprietary frameworks that we've built, stack up the market, understand what good looks like, who's leading, who's lagging. And that's one of the mechanisms through which we've used to conduct this report on building societies we'll be talking through today.
Super, thanks, Ollie. So on to this quickly. The main focus for today is the conversation, but we're just going to do a quick recap of the report and the main findings before we get started. Okay, so I'm just going to share this quickly. Okay. You'd always test these things in the background beforehand, and then there we go. Okay. Okay, so what we're going to do is we're going to give you a really quick view of what we've seen across the 5 of the leading building society mobile applications. So what we did was we took a look at Coventry, Nationwide, Nottingham, Skipton and Yorkshire. We focused on 4 of the key user journeys and experiences within those solutions. So I'll just give you a quick intro to what our approach is and how we tackled the research. So here at BehindLogin, it's all in the name. We focus on real members, people that are existing members of these 5 providers, and we focus on their logged in user experience. So we use screen sharing technology to capture their experience and the live conditions. So we don't do any of this in test labs. We've focused on a set of features and user journeys which we know are proven to drive loyalty and retention. So they're really, really key to focus on. And then we apply our benchmark, which scores the various experiences using objective and measured reviews with our internal experts. So what we do is we come up with our scorecards and we evaluate these experiences, show what best in class looks like, and also identify areas for improvement. So within our recent benchmark, we identified that the big headline: today's building society apps, unfortunately, are far from future ready. Now, this is a big headline and we know this. So what we wanted to do is just give you a really quick look at some of the insights behind this. What you'll see here is just a tiny portion of the screens, which Anna here from our research team and others in the team at BehindLogin dug into to really analyse and review the various experiences across these providers. So we go into all of the details behind this at a very, very granular level, and then we bring it up to a level where we can digest and share it within our benchmark results. So our benchmark, what's it showing? Those of you that have seen the report will be familiar with these positions. If you've not yet seen this report, I will share a copy with anyone that's registered here that hasn't downloaded it after today's session. But what you'll be familiar with is the positioning of Nationwide coming first overall, closely followed by Coventry. Now, what we've done is we've ranked it across a number of different categories. So these journeys that we focused on were first appearance, move money, open a savings account, and find help and support. And within these providers, what we could do is we could see within the report, we've gone into a little bit more detail, which you can have a look at, around examples of what really works and what doesn't work so well for each of those 4 different features. Okay, so there's some really, really good examples in there. So how come we're saying it just meets expectation? What we're going to do is we're going to give you a quick look at the numbers, the actual scores behind these benchmark positions. So what we can see here is a lot of grey, a lot of meets expectation. There's nothing standing out as really poor performance, but there is equally nothing showing as a strong performer or with an exceptional experience. So there is lots of room for improvement and lots of room for disruption. So what we're seeing is that the leaders, the ones which meet expectation, they're doing well in terms of it being logical, easy to consume, fairly reassuring. But the reality is that there are some pretty key pain points. So main challenges that we pulled out in the report, we've highlighted a few of these here, is a reliance on browser views still. There's still a lack of native technology in some instances. In some areas, there's passive support, so it's unclear what the user's journey or experience should be, and there's a lack of clarity in next steps. Quite a lot of the experiences are heavy with words and options once you get deep into the product, so they require quite heavy cognitive demand. And the flow throughout some of these experiences is quite friction heavy. So we're looking at these in isolation, and the classes that we're comparing here are all in a pretty similar space. But what we have to remember is, of course, there's financial disruptors and products from other spaces. So the big question is it okay that these just meet expectation, or is it a sign of an industry at risk? So that's what we're going to be asking the experts, and that's where we're going to start today's conversation. Okay, so we'll just hop back to this one moment. Okay, so starting our conversation today, we'll start with the panel conversation. I've got a question to Jonathan to start us. You work with lots and lots of building societies in this space, and when we first spoke, I think you had a real clarity on what the size and shape of this market is and how big this challenge is. Are you happy to talk us through this, please?
Yeah, of course, Gemma, and thank you for the invite to today's panel. So, yeah, having a good oversight across banking, not just building societies or mutual banks, but certainly this segment is really a backbone of the banking sector in the UK, right? So if you look, they've got collectively across their savings and mortgages book, over 700 billion, right? More or less 50-50 split there across savings and mortgages across 42 building societies, right? You dial back, previous century, there were over 100, right? So huge consolidation here that's going on, which we'll touch on a bit later in this discussion, I'm sure. But, they really do become a pivotal part of across savings and mortgages for the UK financial sector. And if you look at their dominance as well now back on the branch network that they operate, that's also significant, right? Over a third of the branches are now building society owned, as you see the core banks retracting their branch footprint. So there's some really interesting dynamics going on in this sector at the moment. but it's a very powerful, influential sector that needs to go through a lot more innovation and change, not just from an experience perspective, but total operational perspective, where they have relied a lot on maybe some legacy technology, constrained, because they are mutuals, they are constrained on their profitability and putting that back into the business. And then second wave of that is they're competing very heavily with traditional banks and aggregator platforms for these products and offering those services at competitive or products at competitive rates. It's a really challenging position when you've got some building societies at the bottom end with 20, 50 people, and then nationwide with 16 million customers at the top end, completely skewing the numbers here, where clearly they're not even exceptional, right, from your benchmark report, Gemma. So, there's got to be some questions asked here of the industry as a whole to say, if the top quadrant leader in size and volume is not even exceptional from an experience perspective, is that an issue for the industry? I think it's a very valid question.
It's a good question for the leaders of these organisations, in fact, isn't it? And Brendan, I know you work with a lot of the leaders in this space across all sorts of financial institutions, but we know there's specific challenges for the mutuals with the legacy technology. What are you hearing, and how do they see the challenge?
Yeah, I mean, it's interesting, and Jonathan's touched on some very, very valid points there about the legacy technology. And I think, first of all, excellent report. And thank you for the invite. It didn't shock me. In fact, it's kind of what I expected. And I think the context of the building societies is important here. And that legacy technology piece is one that is very valid. A lot of the core systems are 20 to 50 years old in what they're using. So there's no point. And I think the phrase I use is having a Ferrari front end and a Fiat engine in the back. And that will drive the decisions and where they spend. But I think there's a few other things that are relevant here for the context of building societies, and the product mix is huge. These are savings and mortgages that people don't interact with every day. I think in the building societies in the report, only Nationwide has a current account, for example. So again, to Jonathan's point, you would expect them maybe to be better than they are. But for the others and for the wider building society space, they almost just have to be meeting expectations because of how infrequently people need to log on. So I think that product mix and the frequency of engagement is important in determining, do you spend money on something like this, or do you spend money on other parts of your business? I guess the customer demographics is another one. Building societies index higher on age, and therefore, do you need the slickest, quickest, best app, or do you just need things to do the simple things well in the minds of those individuals? And again, the incentives within mutuals, they do have to reinvest profits. They don't have the ability to, go out there and do a new fundraise so that they can get the slickest and quickest. So I actually think as meeting expectations is okay in this space. So maybe I'm being a little bit less critical.
It's really
interesting.
Yeah.
I think that whole almost paradigm between, do people is a meets expectations app that people aren't really using that often because it's just your savings accounts, it's just your mortgage, you don't need to check it that often. Are people not checking it that often because the experience isn't great, or is it because they actually don't want to and don't need to? And if you think about some of the modern fintechs that are like savings-based propositions, they're using like savings pots, 1p challenge, and the big thing the ones that are doing. There's loads of really cool initiatives that are actually driving people to save more, improving their financial habits and all that sort of stuff. So I think for me, it's easy to say yes, building society, yes, older people, they don't really need an app. But then actually, if you think about the main way that consumers engage with technology now, the main way that you build a reputation with the customer, a relationship with the customer, is through that digital experience. And I think share of wallet for a building society, if you look at the baseline business metrics of we want to increase AUM, we want to get bigger share of wallet, the way that you do that is by building a mechanism through which people can actually engage on a more regular basis. So it's a classic narrative building societies, it's older people, they don't necessarily want these slick digital experiences, they're not going to check it out often. I think that's a cop out.
I think, Ollie, it's a valid point, right? So if you look at where the market's heading, definitely there's a shift in age, right? Average age, but then also look at the product penetration here, right? Look at the synergy between a mortgage book of business and savings. They're quite distinct books of business, right? There's lack of cross-pollination there for most building societies, right? It's super, super low. So there's a pivot here that they can make, but they're often running on two separate tech stacks, right? It's a challenge. Yeah, I'll leave it there for now.
So, Ollie, I'm not letting them off the hook. I'm just really saying I understand why they are not the same as slick as Monzo, as slick as Revolut. It's just because of the decisions they have to make and the compromises they have to make. It's a constant battle for building society. Where do they spend their next pound? Because there aren't that many of those pounds to go around, and they've got a lot of other things that, working within the community and helping people from cradle to grave, in a way. And I love working with building societies because they do put customers or members at the heart of everything they do in a way that banks claim they do, but they don't. They live it. It's more vocational. So definitely not letting them off the hook, but the report doesn't shock me, I guess, is the point that I'm trying to make.
Yeah,
It's an
definitely.
interesting one, isn't it? We're kind of split between them being not-for-profits, where there are the challenges that they don't have the big funding and investment rounds that the new fintechs might have. And then you've got the member expectations, who we remember are customers and are experiencing other solutions. So where does the investment go? Ed, what are you seeing across your data points elsewhere? So is this common across all parts of the tech stack? What are building societies investing in experience-wise at the moment?
Sure. Thank you, Gemma, and thank you very much for inviting me to participate. Every year at Contentsquare, we run what we call like a digital experience benchmark report. And this year we analysed 4 billion sessions across 1,000 financial services businesses and websites to get a kind of state of the nation, I suppose. So I'll start with telling you kind of what the numbers are telling us, and then I'll move into where we see some of the investment going more broadly, but some of the building society stuff too. So in terms of what the numbers are telling us, the first thing to say is that traffic is harder and more expensive to acquire. So across financial services, traffic actually declined 3.4% this year. Although banking grew ever so slightly at 0.6%, so there's some resilience there. But the cost of acquiring traffic is rising, with paid traffic versus organic now accounting for 22% of all financial services traffic versus 18% in the previous year. So what this means is organizations are spending a hell of a lot more to acquire the same or fewer number of people. So from a commercial standpoint, that's putting a hell of a lot of pressure on the business, but also putting a lot of emphasis on improving return on ad spend and improving conversion rate optimization. So traffic's down a little bit and it's more expensive to get that traffic. Second thing we're seeing is that engagement and attention is harder to hold. If we think about that kind of Snapchat culture or Instagram culture, it's short, sharp journeys. So consumption, which we define as like page view and scroll depth and time on site, actually fell 11.4% across financial services last year, and that's a much steeper decline than in other industries. So people are visiting building societies and banks with very specific intent, looking to complete their task very quickly and then leave. Banking in particular only had an average of 3 page views per session. So it's these short, sharp, purposeful sessions, and the experience that we need to create has to serve that, and you need to capture that attention very, very quickly. So sorry, I was just going to say, with that in mind, where we're seeing the investment is one is just building new journeys and new experiences that are aligned to that. Things like Ollie mentioned, designing apps that are encouraging people to engage with the building society and the bank more frequently. So we're seeing lots of new redesigns of journeys that are more seamless and slick, but also the launch of lots of new apps. So all the building societies we work with have either launched an app last year or in the process of launching an app this year. So that's a really big theme that we're seeing a hell of a lot of. And the reason they're doing that is to provide convenience for customers, but also to create more value for customers, build better relationships with customers, engage them more frequently and bring them back into the business more regularly.
Interesting. The point about how regularly we engage with our customers. I'm thinking back to Brendan's point earlier around some of these, mortgage customers. It's quite an infrequent engagement, isn't it? You've mentioned there around the cross-sell piece and the fact that actually you're spending more to acquire fewer. So once you've got them, you've got to keep tight hold of them. Brendan, what are leaders saying about the switching culture? What are we seeing there? How does that affect our investment?
Well, I think it's relevant because a lot of people will use comparison engines to find out where the best rates are, and they'll move it. And there's a company in the industry of rate tarts who'll just move the FSCS balance between institutions, and they don't really care where it goes. So they're less bothered by what the name of the institution or the logo is. As long as the app works, they're happy. They can get the savings in, they can get the savings out. So there's that. But then there's also the fact that I think around 80 to 90% of mortgages are originated through a broker channel. So you can have the slickest, quickest mortgage journey in your app or anywhere in your stack. And actually, it's the broker that matters. So back to the investment point, that's probably where a good pound of investment would be spent on the broker journey. So it's complex, and it is interesting. I think there's other ways of engaging with clients through apps. What building societies do brilliantly is they're geographically proximate and they're culturally proximate to all of their customers, and people see the brand on the high street, and they open an account when they're a kid there, and they're very, very valuable. If they could engage earlier with them on the bigger decisions in their life, whether it's savings, whether it's mortgages, and educate them. And I wish I remember the stat, but I was at a conference this week where one of the building society CEOs talked about the number of people who want to get a mortgage but haven't actually engaged with the building society to find out whether they can get one or not. And more people are surprised that they can qualify when they engage with a building society than thought they would be. So the idea is through an app or through other engagement, they would be able to find out more about what's involved in getting a mortgage, how much they qualify for. And that's where I think building societies could make a difference, is reaching out to the customers in their area and trying to get them involved in the process earlier.
More of a personal touch, perhaps. Thanks, Brendan. Jonathan, where you're on the ground with lots of the building societies on scoping where they head, what are we seeing? How can they actually differentiate? What paths are they taking?
Yeah, it's a really interesting dynamic because of the aggregator point there made by Brendan. It's a challenge for them because effectively they're acquiring business, but it's at cost, right? And that's a problem because it's just costing them more and more to Ed's point around cost of traffic, right? It's very high when you go to an aggregator platform for your savings book. So that's a short-term gain. It doesn't help them long-term. So there's concern about that piece. Also concern about, some of these building societies have 5, 10 branches. It's a lifeline for many of their savers or members, but they then have customers from the north of Scotland down to Cornwall, right? And they need to have that relevancy. And I think the concern is, how do we scale and grow the business, in a steady state whilst maintaining costs? But then we don't have intimacy with a local audience, right? It's building that intimacy nationally. It's a real challenge because some of these clients will be highly transactional, and then others will be, very emotive journey, which is maybe more the local markets for them. But I guess the sweet spot here is looking at products like offset mortgages, right, with savings. That hasn't really been tapped into by building societies much. To Brendan's point, okay, early savers, what can they do financially? That can't just be a branch-based discussion. It needs to be something that can be enabled on a digital channel. And I think you saw that in some of your benchmark reports around lack of clarity on service or passive service models. That's not acceptable anymore. We expect reactive service models or proactive, even with the use of agents, right? So I think there is a concern that there'll be more consolidation, right, in this space, and potentially rightly so at the lower levels, at the sort of county level societies, because they can't keep up. They can't keep up with the cost of technology, the cost of meeting operational risk as well is significant. Doesn't matter if you've got 50 or several thousand like Nationwide, you still have to adhere to these regulations and manage the threats around cyber and everything else, right? They're super topical, and it's making sure they've got the tech in place to do it. And I'd say a majority are concerned that they don't have the right tech.
And by the right tech, we're talking both front end and back end, of course.
Yeah, I think back end is probably slightly more steady stakes. We're talking about two products. There's only two building societies that have current accounts, so Cumberland Building Society and Nationwide. The rest are secondary accounts, right? Secondary relationships. So only through open banking can you think about open top-ups, to what you talked about, Ollie, as well, right? That's only through an open banking rail there. Otherwise, it's a secondary relationship. So you think you've got, close to nearly 400 billion of savings across these societies as a secondary relationship, maybe skewed slightly by Nationwide occupying a bit of space there at the top, but it's a huge number. So 4 in 10 adults have a savings account with a mutual, right? It's a huge part, but there isn't really enough about it. There isn't really much self-promotion that they do. It's just almost been grow by default, right, locally. But there's super interesting times. But at the top level, it's cost of tech front to back, more so on the front to middle office, right, sections.
And when we're talking about, I guess, what's possible with open banking and the need to scale, to grow, to personalize, to pull together the recommendations across product lines, how terrifying is that for an organization with lots of legacy tech? Ollie, what's your thoughts on this?
Yeah, I mean, there's so much change, right? The App Store launched in 2008, and then by 5 years later, most major FS providers had a mobile app in the market. And I guess aside from that, the general cost of digital transformation initiatives has historically been massive. And Brendan mentioned earlier around just not having the depth of pocket to go and build these initiatives, build these sexy apps, whatever. Can't go and raise a load of dosh to put towards these things. So naturally, there's been when you're a mutual and you haven't necessarily got those huge profits to invest, then there's been a slow progress to achieving that digital transformation journey. But now what we're seeing with AI, with agents, is the cost of building software is rapidly decreasing. And for a lot of those building societies that perhaps missed the traditional transformation boat, there might be, it's a pretty ambitious claim, but they might be able to ride that secondary wave of AI usage for technology developments to mean they can cut their cost of digital transformation down to significantly less than it would have been 10 years ago. So I think it's an interesting dynamic, and there's so many elements that are required to jump on that bandwagon and ride that wave, and take advantage of those new initiatives that are coming through and that sort of AI. But yeah, it's a telling time, and I'm not really sure what's going to happen, to be honest. I think the baseline has been set. These reports like this just showcase and shine a light on the state of the market and how really meeting expectations. Yeah, that's fine, but actually the expectations of consumers really, someone's not comparing their one building society app to another. They're comparing it to the best digital experiences they use every day. So there's demand for customer, demand from consumers, and this change in technology and the tech stack and tech capabilities, it's all fueling those sorts of things.
So those who missed the transformation boat, I love those who were previously the leaders. Those are the big legacy tech might now be the underdogs about to take the lead again. Ed, are you seeing this elsewhere across other parts of digital?
Yeah, I'm just thinking out loud. I mean, if they're kind of constrained in somewhat because of the legacy tech and how costly it is to transform the back end, perhaps there's some quick wins on the front end and using that as differentiation. So we would encourage businesses in that position to think about what can we do in terms of incremental continuous improvements. Building societies are in a unique position where they already have the trust and member loyalty. So if you double down on the digital experience, you can just compound that. So things like, quick wins, does the site and the app load quickly? Are people able to achieve the outcomes they're coming to achieve? Are we removing friction from the journey? Are pages loading quickly? Are people not encountering bugs and frictions and issues? And being able to identify those things quickly and resolve them, I think can have a massive impact, but also create a business case of the power of digital to support with funding for something more transformational like back-end re-platforms. So at Contentsquare, we're all about continuous improvements and those 1% gains. So people that are constrained with big transformation projects in the meantime should look at continuous improvement where they can.
It's that trust and loyalty point for me that's like the sweet spot that mutuals should lean into to like maintain their differentiation. Nottingham have got that big campaign at the moment where they're keeping their branches and they're saying, Lloyd's has left the high street, but we're still here. And just leaning into that kind of human element that we're still here. We've still got presence. If you want to call us, there'll be someone on the phone that you can chat to in whatever time it is. And when everyone else is driving towards that digital everything, AI everything, actually leaning into that regional presence, that branch-based presence, that person at the end of the phone, that human presence is maintaining that trust and loyalty, Ed, that you said there is so important.
A couple of good points there, Ollie. And I think that handover point is the important. If the app can facilitate a handover to the human quicker, or arrange the branch appointment, or just make sure that they know that, I think that's where they could double down. And your first interaction is with the app, and the second interaction is with exactly what you said. But coming back to the transformation point, it is also important to understand the context here as well, because there's been a number of very high profile failures in terms of transformation in building society, and everybody's a little bit reluctant. I think your point about using AI now is absolutely valid and does present an opportunity. But the difficulty is that a lot of the leadership within building societies are custodians of that building society, as opposed to there because they're going to get a bonus if they do X, Y, or Z, because that's not what it's about. So that sort of makes them default to risk aversion, and therefore nobody really wants to tackle the big hairy problem of digital transformation. They know it needs to be done, but there's other things that sort of occupy their time and percolate to the top of the list around compliance and legal issues and other things, and cutting ribbons at the opening of whatever it is in the local town, and they just don't take it on. And the trouble with the AI-led stuff is I'm not sure that there's enough maturity in that yet for them to say, okay, this is the time we take that risk. But it's coming, and I think that will make a difference. And you're absolutely right on the loyalty and trust piece. That's the bit they've got to double down on.
So we're seeing that they're playing a very, very different game to others in their space because of the very nature of them. What makes them distinct is perhaps their opportunity, but also, of course, the context here.
Yeah, I've always thought that, adding a current account is not that difficult these days with the tech stacks that are out there. And, because they have the trust and the loyalty, it's not that difficult to say, well, you save with us, maybe we could do some more transactions. But actually, a bigger opportunity, I've always thought, is investments. We're teaching you to save, we could help you to invest. And that's where the app could just take things to a completely new level, because you're seeing, I'm coming up to my limit on whatever it is on a savings product. I've got an extra £1,000 that I want to put aside. In the app, it's offered that you can put it into a stocks and shares ISA or whatever it happens to be. And again, that's possible. And that's where you could get the engagement. That's where you could differentiate. But building societies haven't necessarily lent into that yet, into, turning savers into investors, particularly those that are looking and using the building society to save for a deposit for a house, where if they're saving over 5 or 10 years, which is what it takes these days, an investment would give them better returns in the long term to kind of achieve that goal. So there's lots of opportunities, I think.
I think it's a regulated, targeted support coming down the line. I think building societies are super well placed to take advantage of that. So the loosening of definitions of financial advice, basically. And if you've got that relationship, you've got that trust, you've been with someone since their first ever mortgage, and now 30 years later, they've got some spare cash, or they're thinking about, retiring or whatever. And actually, if you've got that relationship, then for me, targeted support presents a huge opportunity for building societies to lean into that, to increase share of wallet. But it can't happen unless they've got those partnerships. Those partnerships nowadays need to be digitally enabled so that you can open those products through the app, whatever it is. Yeah.
I'm just seeing a comment here from Jamie Seekings, he's just posted saying about the potential need for consolidation within this market as well, and how actually that might enable those that are perhaps at the bottom end and lacking scale to embrace that tech development. So it might be that, yes, actually, that consolidation that you mentioned there, Jonathan, could be a path forward for some of this change that's needed. I think we'd probably agree with that.
Agree, Gemma. I think there's absolutely a lot more to happen as expectations rise. You'll see. It's an interesting one, because if you look at retention rates, they're quite high in building societies, right? So the member retention rates are 70+%, right? So it's an interesting dynamic. You'd expect them to be able to grow much more exponentially than they are. But yeah, definitely there's more consolidation. We've seen it probably half this number in 10 years, right, that we see today.
Prediction.
If you look outside of FSI and look at retail with platforms like Shopify or the Hut Group, which service, Ingenuity, it services kind of retail propositions on behalf of businesses. Do you think there might be an opportunity for something like that within financial services, where there becomes a platform that businesses that can't necessarily transform internally can leverage, and that can transform at a quicker rate than they can independently?
But that's been tried. There have been building societies that have come together and they've founded, a tech business that's there to support them, and it works to a point. But I don't think it takes them to that level that, if you're looking at a Monzo or Starling or Revolut sound technology, that they just don't have the bandwidth to do that. And actually, there was a comment made the other day that they're very good at sharing building societies, which they are. They share an awful lot of knowledge with each other, but they haven't demonstrated a great ability to collaborate. And I think that's the missing piece. So consolidation, actually, if that is, pursued by and indulged by the various leadership teams that have their own parishes to look after, I think that does present an opportunity as well.
But I think to follow on from that, Brendan, you see it in Europe a lot where it's shared banking technology from consortium banking, right? To a broader term for it, but it does work. We've just seen it embraced in the UK market before. It could be a time to look at that for building societies. We've seen it with Newcastle Building Society, right? Offering their services out, onboarding a few others.
Yeah.
It's equally stalled now, right? That's not really gone where they thought it would, and a slight retraction on it. So there's an opportunity for that, I would say, for a mid-tier, consolidation platform that they can all buy into, because they all need to offer the same service, but they've got very constrained budgets.
Yeah.
Okay, so we're starting to hear a few predictions here. Is there anything else that we'd expect to see in the coming years? Brendan, do you have any thoughts on what will change in the short term?
I think it's like anything, it'll be incremental until it's not, and people will either run out of road from a technology perspective, or they've kicked the can so far down the road on transformation that something will break, and then there'll be some intervention, and there'll be consolidation. I don't know if I've got any other better predictions than that. I do think consolidation will be a point. I do think there'll be incremental stuff, but there are some very forward-thinking leaders in building societies who want to step up and compete. And they're already doing their transformation. They're already looking at their way of engaging with customers and growing beyond their locality. But it's going to be an interesting space for the next few years. I do wonder what AI will do on the customer side, though, because at the moment, if the focus is all about efficiency internally, I'm interested in your thoughts on this, Jonathan, is what happens if somebody is sending their bot to optimize their savings, where it doesn't matter who the branch is or what the brand is or what the app is, it's just get me the best rate for the next 6 months of my, the focus seems to be internally on AI transformation as opposed to external. And I guess the apps are going to have to reflect that, and the technology stacks more broadly.
It's a good point, Brendan. So I think it's a natural follow-on to say, well, how are we looking at agentic being applied to client-facing channels, right? Not just internally, but it's effectively listening to those, what we call intents, which are coming from either behavior or it's what's happening on an app. Listening to that and then predicting the next step, right? So this is not a chat bot, right? This is not looking at library of resources. This is real time analyzing data with agents. But it's effectively being able to do that. So then it's hyper personalized, but then predictive, right? In the sense that it's actually, and it can be predictive and then go and execute. That's the difference with agentic, right? It's not just coming up with an answer. It's actually then going to execute the answer. And I think that's the interesting part now that we see that ones that have not invested well over the last 5, 10, 15 years could now pivot to, what will effectively be a hollow out strategy, right? Leave everything where it is and go and launch a new tech stack front to back that they can migrate to. But that comes with its own complexities. Right?
Just building on that, I suppose, in terms of how AI is going to be used on the front end customer experience. I think about two of our clients in the UK, one Lloyds Banking Group and the other NatWest. Lloyds very recently released Chat with Spend. It's basically financial advice in your pocket. As a Lloyds customer, you can take your phone out and you can have a conversation with essentially AI to provide personalized recommended insights to you. and NatWest have just released their version of it in beta as of last week. So I think it would be great for some of those more forward thinkers that you mentioned, Brendan, if they could start to adopt some of that capability. It'd be interesting to see where they do. But then to Jonathan's point, platforms like Contentsquare that picks up on all of that intent, those clicks, hovers, scrolls, to every single bit of behavior, how do you feed that bit back into the AI models so that when you're conversing with chat with spend, it's providing tailored, recommended, personalized information to you, and it's a continuous cycle. Gets to know you better the more you interact and engage, and the recommendations get more powerful. So we're seeing that in more of the retail banking world now, and it'll be interesting to see whether some of the market leaders in building societies also adopt that type of tech.
Yeah, I've got a bit more of a dystopian prediction, two-part dystopian prediction for the future. One being that mutuals will see a gradual decline, like popularized in the 70s, right? For people buying their first home in their early 20s. Now those people, they're like the wealth generation at the moment. They hold a lot of the wealth right now, but in the next 5 to 10 years, they're going to start retiring. They're going to start drawing down. They're going to start dying. And the new generation care much less about brand presence, branch presence, sorry, like being able to pick up the phone, etc., etc., and are much more adopters of the Monzos and the Starlings, etc., etc. So I think we'll see a gradual decline in the mutuals market. And then I predict that this is maybe a bit far-fetched, but still plausible with the rate of innovation we're seeing across the AI market, that like 90% of financial institutions that you know of today basically just become an API and a commodity, and a handful of agents basically just own the front end customer experience. And as Jonathan said, like the agentic element where it will just move you around, it will action on your behalf. It will take you from one building society's product to another, to a bank, to an FS, to fintech, whatever. And it'll all be managed through one agent experience. And the concept of mobile apps won't really exist. The concept of individual brands won't really exist. You'll just have your agent and they'll do everything for you.
So I can't contradict that given it's a prediction of the future, but I do think for big decisions like a mortgage that people will seek reassurance before they pay. It's not just about optimizing it. They want to know, is this the right thing? And there will still be a role for branch-based advice or person-to-person advice, whether it's online or whether it's in person. So for savings, I think I agree with you. I think it will just be press a bot, optimize my savings, and off it'll go and do that. And there's a bigger challenge for banks who rely on salaries just to come in at those free credit balances, but that's probably a different panel session. But for mortgages and big decisions like that, I think there'll still be more. There'll be room for advice. There'll be room for brokers, but there'll be room for branches to come and speak to them. It's for people to have that human interaction. But yeah.
34% of 18 to 24-year-olds now get their financial advice from ChatGPT. Yeah. And that's only going one way, right? I mean, yeah, it's crazy. I don't actually, well, maybe it might happen. I think it's pretty far-fetched, but that is, I guess, some of the trends that you see and some of the big, people that are bullish on the AI market are predicting those sorts of things. And with like the rate of change that we've seen literally in the last 2 years, give it 10 years, like, who knows what's going to happen.
The benchmark, the report that I mentioned at the top of the call, did some analysis on this, and AI referred traffic is still very, very small. It's less than 0.1%, but it's highly converting, and it's growing rapidly. It's grew 55% in the last year. So it's growing significantly, and it's having a really big impact on conversion. So whilst it's still very, very small, the early signals are it can be very powerful.
Mm-hmm. I think the consideration around finance is going to be interesting. I think where we're hearing here about the technical advances and how it's going to hold building societies to account, it certainly pairs with what we saw in the report around the gaps for a personal trusted experience. And I think Ben's just put a note on the webinar chat here to your point, Ollie, around the trust and the human handover. And actually, as the technology moves forward and we see people using ChatGPT and other spaces in new ways, that is their expectation. The bar has been raised, and your experience in your mobile app, in branch, wherever, to offer that education and coaching is likely to evolve. So to wrap up, can we have a quick recommendation from each of you on the panel here, and then we'll jump onto Q&As. Okay, start with you.
Oh yeah, no, I'm going to steal Ollie's point and build on it, which is the need for partnerships, because I think building societies have the, as I said earlier, the cultural proximity, the geographic proximity, but they can do more with their clients, and better digital experiences will deliver that, particularly for the younger generations. But there is that context of they don't have the resources necessarily to be able to pilot into this. So I think they need to do more partnerships.
More partnerships. Thanks, Brendan. Jonathan, what would be your recommendation?
Yeah, I think it's the analysis around cost versus mission, right? Where do they really want to go, and how do they achieve that? I think there is huge advancements they're not taking notice of that can really help them here, but it is building that relevancy as part of that strategy, right? So that's one thing which I do think they've lost slightly, where it's they're often in life events where they need to manage, and they're servicing customers that might fall off being approved at the traditional high street banks, and they've got an ability to really segment themselves and establish this rather than a shrink of market. I think, Ollie, I would say it's more consolidation. I think if you look at the size of market, that's not going to disappear. It's been there a long time. It's just, what does that look like? Is that going to be 10 mutual societies? But if we look at where they're moving at the moment, tech is constraining most of this. And the legacy point that Brendan made, there's so many things that are archaic legacy that they just can't break away from, and that's regulation, compliance stopping that. But if we can unpick that, then they can absolutely survive.
Thank you, Jonathan. Ed, would you like anything there?
Yeah, my recommendation would be to lean into their advantage, which is all around trust and loyalty. We know that customers are happiest when they have a combination of kind of digital and human experiences. So I would encourage building societies to get a handle over things like unique IDs, so that they can track customers from digital into store and vice versa, so that they can understand and improve the end-to-end customer experience, whether it is digital or in branch, and continuously optimize that. And it's not easy to do. Often businesses don't have unique IDs in place yet to even track people across journey. So get that in place and use continuous optimization to improve incrementally.
Thanks, Ed. Ollie, do you have anything to add?
Well, all of that stuff, basically, big thumbs up for me on all of those things. I think the partnership point is like critical. I was talking to this fintech the other day, and they built from nothing. They built an entire go-to-market proposition in like 3 months, all through partnerships. That the KYC with someone, they're the banking infrastructure with someone, they're the payments rails with someone, analytics with someone, and then they just built a front end and plugged it all together, and they did that in 3 months. So I think partnerships are the way to accelerate digital transformation. Backbase, for example, great opportunity or proposition around servicing those sorts of things. So I don't think unpicking like legacy technology shouldn't be the primary initiative of a digital transformation project. It should be like, I can't remember the phrase you used, Jonathan, but like ground up, start from zero through partnerships to build the tech stack in a kind of brand new way. I think that's partnerships to enable that would be what I would do.
Okay, super. Thanks, Ollie. I think just whilst we do the wrap up on a few closing thoughts, if anyone who's dialed in has got any questions, please do add them to the Q&A section. We'll have a few minutes at the end here to look at a few questions. So what I'd encourage you to do, obviously we've got a real range of views here, lots of really rich experience in this space. So if anything sounds interesting and would like some more details, I'd really encourage you to speak to any of the experts here. We'll share links links to each of their profiles following this event with everybody. So at BehindLogin here, over the next couple of weeks, we'd like to offer the opportunity for anyone that's dialed into this webinar here to have a one-to-one conversation with us, where we can dive into more detail within the report, focus on specific journeys, give you a few more insights around the scores of particular elements. Certainly, if you're within the report, or if some of your competitors are in the report, you can focus on which of the features or areas stand out to you, and we'd be happy to support you with that as a conversation. We'll share details after the call, so you can easily set up that in the next week or two. Okay, super. So thank you everyone for your thoughts on the panel so far. Do we have any questions at all on the Q&A? We don't have any questions. Okay. In that case, whilst the people that have dialed in are eagerly typing, are there any questions within the panel that anyone here would like to pose to anyone else?
I think, Ed, your point about persistent customer data to track a user across multiple touch points, so not just one session, but that kind of multi-session, and even like omni-channel, like going into branches. Have you got any good examples that you can draw on where that's been done really successfully?
I think it's as I said, I mean, the starting point is getting a unique customer record, like a unique ID, and not all businesses have that in place at the moment. And so there seems to be a race for people to get that. In the meantime, you can continue to optimize channel by channel, but of course it helps to have that holistic view of the entire customer journey and all potential avenues. Off the top of my head, no, but it's the way that people are going, is being able to track a user from web to mobile, to app, to in-store, to online and offline. So I think it's a really important aspect of it. Particularly
Definitely.
in finance, where, in a retail environment, a transaction, if you're buying a pair of jeans, a transaction could happen in a single session. But when we're taking out a mortgage application or we're working with an intermediary, those happens over time. You could start on a Monday and complete on a Friday. So you need technology in place to be able to track that journey cross-device, cross-channel, and over time.
Yeah. And it's the big one that we were briefly chatting about the other day, Ed, around consumer duty. And the whole premise is evidencing good customer outcomes, right? And as you say, the typical financial journey doesn't happen in one session, it happens in multiple sessions. Like in the pensions world, for example, using a pension calculator to realize you're not on track for retirement.
Yep.
Currently the way that you measure it without someone like Contentsquare is you say, oh shit, they didn't actually top up their pension, our pension calculator needs work, But if you can say, well, actually a week later, Ollie came in and did increase his pension by X percentage, then that's a good outcome, and that's evidencing that the tool is still working. So yeah, I think that's, for me, that's a real nice sweet spot as well.
That's a classic one. You think of leading companies like Spotify. I think they knew that if customers created a playlist within the first 2 days of them signing up for a free subscription, they were exponentially more likely to upgrade to a premium version of Spotify. And without being able to track that multi-session, multi-device view, you wouldn't know that type of information. So you can't create these value-creating experiences and behaviors that drive positive business, but also customer outcomes.
And just following that point, Ed, so that's what we see. We see those typical milestones. When you onboard and activate, you've got windows of 30, 60, 90 days to look at multi-product holdings, wraparound services for members, right, or customers. And most of the time it's open a product, I deposit some money, or my mortgage starts, and that's it. And that's not enough, right? That's why they don't have the cross penetration of products, because it's highly transactional, and that's the flip they need to make. But they don't have the unique IDs, to your point, Ed, super complex to do here anyway, because their core systems are too old, right, to cope with this. But it's the tracking piece, right? I think that's going to be a super interesting area. But it is that activation journey, or as we call custom lifetime orchestration. It's understanding that activation journey, but there's a sweet spot. Go beyond that 3 months, depending on complexity of product that you're offering. But it's that initial period. If they're neglected, you often won't retain that client or customer, and then equally you won't have multiple product holdings.
Yeah,
Is it possible to overlay that unique ID that you're looking for, Ed, or do you have to effectively just start from scratch?
I think there's a lot of data plumbing over and above my head that's involved. And as systems becoming more and more complex, as more and more systems are involved and included, it's quite technical.
Yeah.
Yeah.
Mm-hmm. Okay, so the results of the poll are in. So predictions for the next 3 years ahead. Half of the people on this call anticipate that there'll be gradual change. So those who invest in their experience will win and others will lose position or merge. We've just got one person who thinks that no change is needed. Digital and mobile experience is less relevant in this sector. And a third of people are anticipating major change. Disruption's already on its way from fintech and others. So we know that change is coming. And if you are evaluating your digital position, your specific features, we can support with those benchmarks, those specific areas where we can compare you against your competition and help you to prioritise that investment. Okay. Any closing thoughts, Ollie?
No, all good. Just thanks to everyone for joining. Really interesting panel. Nice to get some thoughts and hear from some experts. So thanks for coming, everyone.
Thank you all for your contributions, and thank you everyone for dialing in.